You're listening to the Cash Podcast, creating affluence, success, and happiness with your financial surgeon, Adam Koós, President and Portfolio Manager at Libertas Wealth Management Group at libertaswealth.com.
All right, happy Friday, everybody. This is October 23rd. I'm recording this on the market close on October 22nd. So just as an FYI, I typically record these a day before we post them. But for those of you who are subscribers, then you get the updates right away. Obviously, you get notifications, potentially emails if you sign up for those. But so here we are with 1 week, just over 1 week left to go before Election Day. Investors are nervous. The stock market's a little choppy. And a lot of people want to know who the next president of the United States is going to be for the next 4 years. So we're going to talk all about that again today. The stock market, we're going to talk about the economy. We're going to talk about some statistics, some potential predictions that could take place. And we're also going to talk a little bit about what happens after the election is over with and what we might be able to expect depending on who the president is, who wins Congress, and who wins the Senate. So we're going to go over all that. But first, as always, a few housekeeping items. If this is your first time listening or watching, for that matter, on YouTube, thanks for joining us. The Cash Podcast is produced every week. And as stated in the intro, Cash stands for creating affluence, success, and happiness. And that's our mission. My hope is for you to learn a little bit more on each and every episode so that you become more successful, wealthier, happier, and more educated than you were before you started listening today. So come back often. Feel free to subscribe on both iTunes and YouTube. In addition, you can also follow me on Twitter at Adam Koós and on Instagram at Financial Surgeon. Last but not least, all links, visuals, and other educational resources are available on our website at libertaswealth.com. We are going to have about 5, I believe, images that I put together for today's podcast that are going to be available online on the website, and I'll number them, and I'll do my very best, as always, for those of you who are listening on iTunes to talk you through what we're looking at. And then, of course, you can always go back to our website and check out the images later, or you could always check out the YouTube link and watch and listen as you go. So without further ado, let's go ahead and get started here. So the first thing I wanted to go over, as I always do, is just a quick quote. And I always like to find one that's applicable to the times we're living in, and this one definitely does. So this was Bill Gates, who said, "Headlines, in a way, are what mislead you, because bad news is always a headline, and gradual improvement is not." So it's always important, I think, for any investor, anybody who's worried about their money, their retirement planning, to try not to allow these headlines to freak you out. Don't get me wrong, I'm not being complacent here. I'm not trying to say that you should completely ignore what's going on in the world. I think it's crucial to pay attention to what's going on in the world, but I think it's less important, and this is really important. It's much less important to pay attention to what's going on or what the headline is, and much more crucially important to pay attention to how the market reacts to those headlines. If a headline comes out that seems terrible, but the market doesn't react to it in a negative way, then the headline is irrelevant and it doesn't matter. So I think if we could all train our brains, and it's extremely difficult to do as human beings, we're very emotional people. It's very difficult to take these headlines and these news clips and these things that come out that are designed by people, great journalists who are very, very good at what they do. They're designed to scare us. They're designed to get a rise in us. If we could just get ourselves to a point where instead of looking at the headlines and allowing them to upset us or make us worry, to instead look at how the stock market and how our investments react to that news, that would say a whole lot more, obviously, than the headlines themselves. So, speaking of what we have going on, obviously, here, 1 week and a few days. There's not too many trading days left, that's for sure, between now and the election. So tonight is Thursday. I'm recording this at almost 5. Actually, it's 5 o'clock on the dot after the market close on Thursday. And we have 1 week and 5 days left to the election. A little bit less trading days. We've got 6 trading days left before the election. So there's not a whole lot of time left before we have the election. Obviously, there's a lot of people that think that we might not know who our president is because of what's going on with the pandemic, a lot of mail-in votes, a lot of early voting. There's always the talk about voter fraud. Again, that's a word that freaks people out, or a word that really gets a rise out of people, the word fraud. So call it what you want. There was a time back, I believe it was during the Bush and Gore election, where we didn't even know who our president was until January of the following year. And you know what? We're all still alive. We're all still hanging out with our families. And everything ended up just fine since that election. So I don't think it's the end of the world if we don't find out who our president is that evening or the next morning or even that week for that matter. That all being said, for those of you who are watching on YouTube, I'm going to go left to right here. For those of you who are listening, I'm going to talk you through this. But what we're looking at here, or what you're listening to, are the statistics, the historical returns of the stock market. It's the S&P 500. Historical returns since pretty much World War II, so since 1950, the average annualized rate of return of the S&P 500, depending on whether or not we have a Democrat as our president, a Republican as our president, whether we have a Democratic Congress and Senate, a Republican Congress and Senate, a split Congress and Senate where one's Democratic, the other one's Republican, so gridlock, if you will. And then we'll go over the same thing with just the opposite. So if we have a Republican president and then we have a Republican House and Senate, a Republican president with a Democratic House and Senate, or a split House and Senate. And here's how the numbers sound. So first and foremost, Democratic president. So if Biden were to win the election and we have a sweep of the House and Senate, the annualized rate of return for the stock market since 1950 was 14.3% per year. And I'll go through these from left to right one more time at the end, so I'll summarize. If we have a Biden win, so a Democratic president, and a Republican House and Senate, then we have the annualized rate of return for the S&P 500. It's 18.5% per year. If we have a Democratic president and a split House and Senate, then what we have is a 16% annualized rate of return. Okay, so that's if the Democrats were to win the presidency. Now, if the Republicans were to win the presidency, then things look a little bit different. So Republican wins the president, so let's just say Trump won re-election. The annualized rate of return for the S&P 500 since 1950 is 10.7%. If Republicans controlled the House, the Senate, and if a Republican is president. If a Republican wins and we have a Democratic House and Senate, then the annualized rate of return for the S&P 500 since 1950 is 7.5% per year. So that's Republican president. We have Democratic House and Senate, 7.5% per year. And then last but not least, Republican president, but a split House and Senate, annualized rate of return for the stock market, 17.6% since 1950. So I'm going to go through that one more time super quick for the people on iTunes. If we have a Democratic president with a Democratic House and a Democratic Senate, 14.3%. Democratic president, Republican House, Republican Senate, 18.5%. Democratic president with Republican and House split between Republicans and Democrats, Congress and Senate split, 16%. Switch gears to Republicans. So if Republicans win, we have a Republican sweep, 10.7%. If we have a Republican president, but the House and the Senate are Democratic controlled, 7.5% per year. And again, Republican president, but the House and the Senate are split, 17.6%. So what that tells me is a couple things. I'm not going to get into the politics of who has the higher rate of return or why that might be. It doesn't make any difference. We can only control it to a certain extent. So let's not get all riled up here. And this isn't meant to be political. It's meant to show you and to teach you that while there may be some combinations that are better than the others, overall, it's not bad. It's not horrible. And I think one thing's for sure, that if you compare a controlled Senate, House, and presidency to a split gridlock presidency, then I think we want gridlock. I mean, I think split's kind of the way to go across the board. I always like to joke that whenever politicians can't do anything, that's usually best for the stock market. Best to let kind of free markets go do their thing. So anyway, I think that this is not bad news across the board. Obviously, there is better news historically speaking, and again, you can always say that these are just historical statistics, and that's all they are, is statistics. So obviously, these numbers change after every single election. It could be that we end up with a Democratic president and they take over the Democrats take over the House and the Senate, and we have a wonderful record year in 2021. It's possible. We could also see a horrible year. Furthermore, we could have the Republicans, let's just say they take over the House and Senate and Trump gets reelected, then we could have a situation where instead of 10.7% per year, it could be one of the weakest years on record. It could also be one of the best. We just don't know. But these are the averages. And when we look at the averages, if you average all these out across the board, again, they're not bad. It's not like if we have one or the other president win, that the sky is going to fall and that we're going to have all of our portfolios are going to go down, a bunch because the stock market crashes as soon as the election's over. It doesn't work that way. In fact, unless, I don't know how many of you who are listening or watching paid really close attention to the last election, but I did. I was up almost all night paying attention. On one hand, I had the TV up with the election on TV with all the news, and on the other hand, I had my laptop open next to me, and I was watching S&P 500 futures. So I was basically watching the stock market, S&P 500 futures and Dow futures, and it was really interesting to see how things changed overnight, and really how little all of it mattered. And again, I go back to the quote, the Bill Gates quote earlier. What matters is not the headlines or what happens. What matters is how the market reacts to it. So as much as there are several people, millions of people, millions of people who would be really, really upset if Biden were to lose, the last time Trump won, the market ended up doing extremely well after that, contrary to many's beliefs. There are also millions of people who will be really, really upset if Trump doesn't win re-election. And they're going to have all kinds of reasons why that's going to be bad for the economy and bad for their pocket. And they could be right in some situations, but at the end of the day, it's all about how the market reacts to that news. And one of the biggest rules in investing is not to anticipate. It's always best to follow whatever the trend happens to be as opposed to trying to predict it or trying to front run it. So I'll shut up and move on to the next slide here. So what do we got? The next slide is a little bit more conceptual, a little bit easier to look at. This is since 1945. What you're looking at is the stock market in just a line chart and how it performed depending on whether or not there was a Democrat as a president or a Republican as a president. And that's it. Pretty simple. So we from left to right here, you already saw the numbers in the statistics or you just heard them on iTunes. And you can see here that from 1945 until 1953, we have, looks like the market went up. Market went up again during the Republican presidency. Went up again during the Democratic presidency. And then we had the 73-74 crash in here. As well as the crash in the late 60s, and the market pretty much went nowhere to down during that presidency. Then Democrats took control in the late 70s, market goes up, Republicans take control in the early 80s, and pretty much hold on to the control of the presidency for quite a while here, and the market went up. The Democrats take over in the mid-90s with Bill Clinton. Market goes up. We have one of the biggest bull markets in U.S. history, some of the most preferential tax treatment on investments in U.S. history. It was a great time to be in the stock market. And then we have the 2000 to 2008 market, where the market goes through not one, but two huge market crashes between 2000, 2001, and 2002, when the market went down 47% from top to bottom. And then from 2007 through 2009, we did an 18-month period where the market went down almost 58% in 18 months. And then after it bottomed, then we have the Democrats taking control of the presidency again. Market has a nice run from 2008 to 2016. Republicans get control again in 2016, and the market's up since then. So that's that. And you can see how, you can pick and choose whatever lines you want, but at the end of the day, whether there's a Republican as president or a Democrat as the president, I think you can see that it's not horribly bad news in any one situation consistently across time. So moving on to my election tracker. Again, I keep tracking this each and every week. In fact, I'm going to come out with another update of this chart at the market close probably on Monday. We'll see what happens over the weekend. But what this chart does, for those of you who are seeing it for the first time, is it predicts with 87% accuracy looking back in time since the 1800s, since the first presidential election, basically, going all the way back in time, we have the prediction of who's going to win the stock market. And what we do is we go back 3 months and we say, okay, in the 3 months leading up to election day, if the stock market is up, then the incumbent wins the election 87% of the time going back in history. If the stock market is down in the 3 months leading up to election day, then the challenger wins. And by the way, it doesn't matter whether the challenger's a Democrat or Republican, or if the incumbent is a Republican or a Democrat. This statistic has everything to do with who the incumbent is in terms of whether the incumbent wins or not, or whether the challenger wins or not, and it has nothing to do with who's in office. So right now, this year, it just happens to be that we have a Republican in office, and the Republican is therefore the incumbent. So if the stock market ends positive by election day, which again is not too far, obviously it's a week and a couple days from now, 6 trading days from now, then there is an 87% probability looking back in time that the incumbent would win. Now, does that mean it's going to happen this time? No idea. I mean, I think we're living in unprecedented times. Obviously, we're living in a pandemic. There's tens of millions of people unemployed. I don't think anybody could predict this election. Maybe the bettors overseas, the betting odds over in Europe perhaps, but I don't even think they got it right last time around. So what I'm seeing right here is just one clue, if you will, one statistic or metric that we can look at that might give us an idea of who might win. But at the same time, again, we could end up seeing Biden winning next week, and then all of a sudden, instead of 87% accuracy, the statistic becomes less accurate, right? So that's that. Let's just say, for those of you who would be really upset if Trump were to win a re-election, looking up here at the top, you can see this is the S&P 500 performance. This is my friend Ryan Dietrich at LPL. He's head of technical analysis there. He put this chart up literally just, I think it was last night, maybe it was today, on Twitter, and I sent him an email and said, hey, I need a higher resolution picture of this thing, and he put together a blog and shared with me an even higher resolution picture so I could turn around and share it with you. But this is a chart that goes back and basically says what the S&P 500 for what the stock market's performance is after election years, if the president wins re-election or if there's a new president in office. Again, I want to reiterate, this has nothing to do with whether or not it's a Republican or a Democrat winning. This is just saying if a president wins re-election, how does the stock market do after election years? So in post-election years. And if a new president comes into office, how does the performance of the stock market look if the challenger wins? And you can see here that even if you're on voting for Biden, and if Trump were to win, the good news is the statistic since 1950 says that if the president wins re-election, so in this case it would be Trump, the average rate of return for the stock market is 9.6% per year. Not so bad. If the challenger wins, the average rate of return is 4.8% per year. Almost half, actually. So it's, again, the message I'm trying to share here is even if the president that you want to lose ends up winning, not all is lost from the standpoint of your money and your retirement planning. Maybe there's other things you'd be concerned about, and of course those things are important. But in terms of what we're talking about here and what, my wheelhouse being retirement planning, investment management, and things that we're talking about specifically having to do with your money, I think that wouldn't be the end of the world. And then last but not least, a quick stock market update on where we are at today. I'll talk you through this again if you're on iTunes. What we're looking at is a stock market chart since February of this year. So this is just 2020 February. And what I have here is a line drawn from the top of the February highs before we had the record fastest stock market crash in history between February and March in only 22 days. And I've drawn that line all the way over to where we are today. And what we're seeing right now is that the market is starting to head down to and almost like fight with that line in the sand. So in other words, if you drew a line across a chart, across an S&P 500 chart, from the February highs all the way over to present, you would see that the stock market has printed a lower high, which is not good, but we don't have a higher low yet. So it's basically going sideways. There is no short-term trend right now. So what we have is a high printed in early September. We have a low printed in late September, and then we have a lower high in early October, so earlier this month. And now we have the market just kind of pulling back, likely due to uncertainty with the election, people freaking out, and it's kind of butting up against those February highs, which act as a technical floor of support below our feet, where if the market were to break that floor of support, the next level in the sand for me would be the 50-day moving average, which is this blue shaded area here. This is what I call, if the market goes below this level, I call this being underwater. And we don't want to be underwater, obviously. And then the last ditch area where I think we'd be potentially in big trouble, or the market would be in big trouble, would be if the market were to fall below this red dashed line, or for those of you listening on iTunes, if the market falls below the September lows, that would obviously not be a good thing, and would be a very negative sign potentially for things to come. So that's all I've got today. Thank you so much for watching. That's it for our show, but feel free to share this episode with your friends and family. And if you'd like to discuss your personal situations further, please remember that you never have to be a client to ask a question. You can email me, you can call our office, set up a phone appointment online. You can also set up a Zoom meeting on our website. Just go over to our website to the contact page, and you can get access to my calendar there. As I always say, there are thousands and thousands of podcasts out there, and you chose to give ours a listen. So thank you so much for tuning in. Be sure to subscribe on iTunes and YouTube. And remember, you can sign up at libertaswealth.com to get these updates as well as other screencasts, videos, and articles delivered directly to your email inbox. Feel free to follow us on Facebook at facebook.com/Libertas Wealth. And I'm also, again, on Twitter at Adam Koos, as well as Instagram at Financial Surgeon. Again, thank you so much once again for joining us, and we'll see you next time.
Thank you for listening to the Cash Podcast with your financial surgeon, Adam Koos. To see any charts or images that were mentioned in this show, or to check out additional articles, videos, and other educational resources, head over to libertaswealth.com.